Milei on economic issues, interest rates. In this talk, Milei has a very interesting and contrarian point of view about interest rates. Milei states that interest rates occur whether there's money or not. Interest rates are a function of time, they're not a function of money.
Because the interest rate exists regardless of the existence of money. The interest rate exists because time exists. The interest rate has to do with the mechanism of passing consumption over time. In other words, saving, which is future consumption, is a way of passing consumption over time. So, those who are indebted are the ones who advance consumption, and those who lose are the ones who defer consumption. And that is independent of the existence of the central bank. The interest rate has to do with the relative price of the present assets compared to the future assets. It has nothing to do with a monetary issue. It exists because time exists. Otherwise, there would be no interest rate. It would be a mess that has no explanation, like the case of Keynesian general theory. It's a mistake that we've been dragging around for a long time.
Here Milei points out that demand for money is based on the demand for goods, and this follows directly from the idea that money is an indirect good. Then he points out that all the macroeconomics textbooks that say that the demand for money is based on the interest rates and income are wrong.
And this is interesting, because if it's a mirror of the demand for goods, all the macroeconomics books that say that the demand for money is a function of income and the interest rate are wrong. In reality, the demand for money depends on consumption, and obviously it depends on the intertemporal path of consumption. And if I want to take out the fact that it's depending, why am I? Where to put the income? Because if I'm building a general equilibrium system, my income comes from a sale of leisure in the labor market, and it comes from the participation of the benefits of the companies. Therefore, I don't have to put the income. That's an aberration. That's a blow that Keynes made to be able to invent the effect of adjusting quantities, and above all invent the Keynesian multiplier, which is to violate the budget restriction.
So by misinterpreting where the demand for money comes from, Keynesians are able to create their absurd multiplier effect.
Of course, by violating the budget restriction. Of course, if you finance it with monetary emissions, it generates inflation, ma'am. Yes, it generates inflation. If you finance it with monetary emissions, it generates inflation. And in other countries that have a deficit, they finance it with debt remuneration. That is not the central bank. Now then, it means that my function of money demand now depends on my intertemporal path of consumption. I have to know where the demand for consumption comes from. If you do an exercise, you take a microbook, and when you look at the functions of excess demand, of general balance, or the function of demand for a good, what does it depend on? All the prices of the economy. That is, if the income does not appear, all the prices of the economy appear. And at the same time, if that economy is intertemporal, it includes today's prices, tomorrow's prices, and so on. The interest rate is implicit in the part of the price vector that contains the future prices. Therefore, let's say the money demand depends on consumption.
Here, Milei describes how all the conventional economists told him they'd have to raise interest rates to a positive real rate in order to bring down inflation, and he shows why this would have led to catastrophic results.
What happened in terms of interest rates is a great triumph that we have also had in terms of economic theory, because what did the economists tell us? That we had to raise the interest rate. If we had raised the interest rate, the balance of the central bank would have exploded. In this way, having jumped the type of exchange to a level similar to the parallel exchange corrected by the country's tax. In that context, what happened at the interest rate in dollars arbitrated with the one in pesos, but the one in pesos meant being negative in real terms, and that also allowed us to liquefy the stock of passives that so that you learn in monetary theory, it is not only a matter of looking at flows. The stocks are also looked at. And sometimes a problem of the stocks is much bigger than one imagines, because in fact it generated a quasi-fiscal deficit, which was twice the fiscal deficit. In that sense, we decided to go and to something more radicalized, because what happens when you have control of capital, which we need to have until we finish fixing the stock problems, and until we finish cleaning the money overhang will disappear when the inflation is zero, the macroeconomics is zero. You have the absurd and the induced. The macroeconomics is the one in the middle. What is that residue? That today, the wholesale inflation is 0.5, the consumer inflation is 1.5, and that is going to disappear.
So Milei taught us interest rates exist independent of money. They exist because time exists, and because there's a preference between goods consumed now and consumed in the future. He also showed us that the demand for money is not a function of interest rates. The demand for money is based on the demand for goods, because money is an indirect good. Finally, he showed that it's possible to lower inflation without having a positive real interest rate, thus destroying the Phillips curve. Long live freedom, damn it.